welcome to the Capital Discussions Market Analysis. I'm Tom Nunemaker with Jim Riggio. Before we get started, this is our disclaimer. It's at the bottom of all of our web pages. The Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. We believe hypothetical computer-simulated trades are accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. So with that out of the way, Jim, let me pass the ball to you. The second, Jim Riggio. Did I give it to the right one?
I think so. Let me try to share my desktop, and I will tell you.
It looks like it's sharing something.
There we go. Okay.
Yep, thanks for using WebEx. Okay.
Tom, I wanted to end up sharing something that we had talked about, but Goldman Sachs actually came out with a research note on it last week, and I thought I'd end up sharing, some of this. I can't send any of this out to folks, so I just wanted to end up making reference to it. And it was the level that the VIX, first of all, and we've been talking about this, how much the VIX jumped last week with the market pullback. And we also made comments about how the VIX, okay, the VIX on the VIX, right, the volatility index of the VIX, how that moved up even more. While we knew that and we had pointed it out, I didn't realize just the level of historical move that we ended up having last week. The VIX had its third highest close in history. Now, the other two were in the middle of financial crises or the U.S. debt being downgraded. It was during extreme market turmoil. So the market had moved pretty significantly, meaning the volatility had moved pretty significantly compared to what the underlying S&P had done. I just wanted to share a couple of things with you real quick on it, and that was here. It's just a list, right? The top one is a list of the highest moves or the largest moves in history of the VIX. When you take a look at it, we moved 78% a couple of weeks ago on December 12th. If you take a look at the move that we ended up having in October, remember the October pullback we had, that moved 74%. That was the largest. Okay. I mean, we've had two of the top 10 largest VIX moves in the last month and a half. Now, when you think about what's been going on, the market doesn't feel like it's been, two of the 10 worst trading days since, 1994, okay? But that's what the VIX had been telling us. Now, the thing was that the VIX even had a bigger jump. If you take a look on that same day, on December 12th, it had reached the third highest point. The volatility on the VIX, the bottom one here, had reached the third highest point it had ever been. Now, I knew it didn't look good, but it didn't look like the world was ending. So the market had really, really overreacted. I'm going to show you a graph on Thinkorswim in a minute. I just wanted to show you one other thing, and that was this graph down here. And that was that what Goldman Sachs does is that they break down the volatility indexes into up days and down days, right? Because the market always seems to go down quicker and volatility ends up popping a lot quicker. And with the sell-off that we ended up having, okay, if they end up taking a look from early November, what ended up happening is the bottom line is what they would end up predicting based on their beta, their up and down beta of the VIX, and the darker blue line is what it actually moved to. So you can end up seeing that it moved more than a third or about a third higher than you would have expected it to. It was nearly 5 points. The VIX was nearly 5 points higher than what their volatility models and their beta of where the S&P was versus the VIX had moved. So we had some real substantial moves. And I wanted to end up sharing, so we had been seeing this, but we weren't the only ones. I mean, it was to the point that they came out with a research note. What I wanted to end up showing you, and this is the way I had noticed this, okay, and I had shared this with you guys before. All I have on the top graph here is you're looking at the VIX with the candles, and on the left-hand side, okay, is the VVIX scale, and on the right-hand side is the VIX scale. Now, these things tend to end up moving pretty close to in tandem, right? When one ends up moving up, they both end up moving up. So what you're looking at, because you have different scales, they are a function of one another. But what I want you to take a look at, look on the scale over here where the VVIX started, right? It started much lower than the VIX, and you can see here that on the spike, it moved much higher. We've been coming down together. The VIX had sold off more, but I do think for us to end up getting back into, a more of a normal environment, that the VVIX is going to have to end up coming down. Now, remember, that's the volatility on the VIX options. Don't forget that the volatility on the VIX options, while they're traded on the underlying, they kind of do trade quasi-similar, actually very similar to the VIX futures. The VIX futures are what's used to build out the VXX and the UVXY and the VIXY and the rest of those VIX-based products. So what this is telling me is that either things are going to have to start to get a little bit more volatile, or the VIX-based ETFs should be coming in somewhat more, between now and the new year. On the bottom, if you remember, what we ended up taking a look at, this was the live version, okay, with a graph of what you end up seeing in a delayed model on VIX Central. The purple line, which has the most volatility, obviously, is the front month futures minus the VIX. So because the VIX spot tends to end up being much more volatile, it moved all over the place. But what I wanted to end up doing is if I take out that graph, right, if I take this one out and I delete the study, what you can end up seeing here is that in a normal contango environment, okay, the green line is the second month, right? I always do them red, green, yellow, red, right? So the green is always going to end up being the second month minus the first month's futures. That tends to end up having, if you end up going and you're taking a look at VIX Central, okay, just so I know, because a lot of people end up looking at that. Okay, that tends to end up being, that's the first month, right? So what I'm looking at is that the first month, okay, what they have here is the second month minus the first month futures. Okay, in the graph that I ended up having, so you can see that's a 3.6% contango. That's the green line. Okay, that's the green line. That's the second month minus the front month. You can see that that's gotten into a much more normal environment over the last couple of days. You can also end up seeing that the second month or the third month minus the second month, which I always denote in yellow, it's also come back somewhat. It's kind of interesting that they barely went into, okay, they barely went into backwardation. Both of them did over here on this horrible day that we were talking about. Now, when I've taken a look and I've gone back and I looked at all of those worst days in history, we were in severe backwardation. So, the market here was showing us some real mixed signals, but it does appear that things are getting somewhat back, okay, to normal. So Ray ended up asking if I could talk about the horizontal green dash line in relationship to the solid lines, and I'm assuming that's on VIX. Oh, there's the second one, on VIX Central. I definitely can. You know, one of the things that you can end up seeing over here, this solid green line, this is basically the VIX spot. Okay, it's showing you where the VIX is. On that day that we were talking about when the VIX, the VVIX and everything was so high, this, I don't know if, they won't show it to us because if you go into historical prices, they don't have the actual spot. But let's go on to that day. Let's just choose it. Tom, would you do me a favor? Would you take a look and see what the VIX was on what were we talking on the 14th, was it? What day?
Let me look it up.
Yeah, if you would. Okay, and I just want to end up going back to my, it's the 12th. 12/12. Okay, so if I come over here and I take a look at December 12th, get prices. Okay. Now, this is the end of day pricing. Okay. If you also end up taking a look at the 12th,
Yeah, it looks like it closed at 2108 on the 12th.
it closed at 2108. Do you know what? Let's go and take a look over here, by the way, because I do actually have it right here, right? But take a look at these spikes. Okay. What ended up happening here, they were getting these huge spikes. Now, don't forget, the VIX is calculated off of the mid-prices. All right, it's calculated off of the mid-price of the options. What was happening during these days was that a bunch of market makers were readjusting their models, and as they were readjusting their models, they were making the bid-ask spreads extremely wide. That's why you were getting these just huge fluctuations all over the place. Then what ended up happening is, and if we come back to, what was it last, I guess, Friday, you know, we can end up seeing just how high we got, okay, on Friday and on Monday and on Tuesday. Now, what ended up happening was that there were two things, I think, that kind of ended up really, if you will, breaking the back of the volatility. The first one, which kind of stabilized things so we weren't going any higher, was, and we talked a little bit about this, and this was oil. Let me see if I have the oil here that I can show you. Did I save it? Hopefully I did. I did. How about that? Okay. And if I come over to here, and I end up showing, I guess I should have saved it as CL. I didn't save it as CL. Okay. So here it is, and you can see I kind of highlighted these things here. This was the second highest trading day, or about tied for the second highest trading day in the last 2 years. We had a huge doji candle, okay, on this day. Now, the other thing that ended up happening with this particular day is that if I end up, I don't know if I can still show you if they still have it. Let's see if they still have the 15-minute data. Can I go out? How far can I go out for 15-minute data? Can I go out to 20 days? 20 days will probably get me there. Okay. Here, I'm going to end up highlighting this area. Take a look at the up movement versus the down movement. This huge surge back up was on bigger volume. They tried to sell it off, and the volume came back in. And then at the end over here, what ended up happening is that when they tried to end up selling it off, this, I think, is the critical point. Yet when you have that much volume, they were trying to sell it off, but buyers were stepping in. Buyers were stepping. They stepped in to bring it up. So most of your volume was on up volume. Like this little sell-off here at the end of the day was on pretty small volume. Now, don't forget, Okay, this was also Expiration Friday. So there's a lot of window dressing in the sense that a lot of large institutions, okay, ended up having, okay, their options in place. They were running their contracts right into expiration. So it kind of ended up telling me that when I take a look at the larger piece, they come on the daily side, and here we take a look at this. To this point on expiration here, a lot of the selling may have been done. And so, we had seen that when it first happened. Didn't know if it was going to hold or not. It is a pretty classic, just because it's technicals don't always work, by the way. Just because it's a classical doji, okay, reversal candle, and you had more up volume than down volume, doesn't mean that it can't just be a dead cat bounce, and from a fundamental point of view, there's going to be more selling going on. So that was the first thing that happened. And then the second thing that ended up happening later in the week was that the Fed came out, okay, with their rate decision. And while they changed the language, and everybody expected them to change the extended period of time language, they changed it in such a way that the market was comfortable with it. They ended up having a little bit more certainty that they weren't going to end up raising rates anytime soon, probably not until the second half of next year. And the market took that. A lot of the volatility came out, and we were basically off to the races. So those were the things that were really interesting to me, last week and what had been going on. And that was pretty much, the biggest thing that I had seen, Tom, that I wanted to end up sharing. Anything that, you wanted to end up bringing up?
Not really. I mean, you covered it pretty well. The doji on the oil was a great call on the market reversal in the U.S. equities, and then the Fed. My gosh, what a reaction to that! I think
right. You can see right
crashed like that.
Right. So this was basically the Fed day, right?
Yep.
And we've been going ever since. Now, you take a look at this, and I know that these are big moves, right? I know that these are big moves. I'm not saying that they're not. But are these two of the 10 worst moves in the history of the market going back to the 90s? I don't think even close.
Well, it's like I was saying earlier, if you didn't know the price action of SPX and you were just looking at the VIX, you would think that we're in some massive collapse of the market or something, but nothing like this.
Right, and that's what, in a numerical form, that's what, we had seen this, we had talked about it. The Goldman Research note, they have a lot more quants and computers than we do, okay? But we told you in real time, okay?
Stephen asked, are these V-bottom rips we saw in October and December indicative of strength or a topping process?
That's a really, really good question. For those of you who watched Bill Visconto last Thursday in the roundtable, I know he and I had been talking about this. As volatility and risk management and hedging experts that Bill and his EAB team are, he doesn't have a problem with the market ripping down. It's like that ends up being pretty normal. He has a problem with the way it rips up because normal hedging doesn't end up working as well. What I think, to answer the question, is this a topping pattern or is this strength? I think that we are continuing to be central bank driven. Okay, I think that the sell-off in oil was, very commodity and specific to commodity sell-off. Some of the selling pressure, and they also ended up saying this, and right, we had also talked about this. Let me show you the other part of the note at the beginning. Right, when they ended up taking a look at what happened to XLE versus the high yield spreads, there was a big difference. They ended up making the point that most of the rip down was because of oil and some of the credit issues in high yield, specifically to the energy sector, and the commodity base. Topping pattern or further up. You know, for a long time I thought that we would look like we were starting to top. And I had been negative for a long, long time. But, you know, one of the things, and I was, I went back and I was reading a couple things. I don't know if you guys have ever read any of Bart DiLadito, I think his name is. He was the PhD guy who did some of the initial work for I forgot what name it was. I forgot what system he ended up doing. VectorVest, that was it. And you know, one of the points that he bases all of his studies on is whether or not the stock market is attractive. And the way he ends up, you know, I mean, it's more complicated than this, but, you know, one of the basic ways that he ends up taking a look at if the stock market is attractive is what are the triple B, right? He's trying to do one notch above junk. What the, I'm not going to call them high yield, but close to high yield investment, close to high yield bonds paying versus what's the earnings yield. Earnings yield, okay? Earning yields of companies are the following. Everybody, you know, you always talk about price to earnings multiples. All that is that's the price, right? It's the price divided by the earnings. Just flip it on its head, right? Just do the reciprocal of that. So instead of it being or a price to earnings ratio of say being 20, it's 1/20 or 5%. Which is more attractive? Are the companies earning enough money so that they're paying more than the triple B bond index? If they are, stocks are attractive. If they're not, then bonds are attractive. Basically, what's happened here is that as long as the Federal Reserve in this country and the central banks around the world are suppressing rates by buying back their own bonds, it's going to push interest rates down, which makes it much, much easier for the earnings yield to beat that ratio. Okay, I mean, this is probably one of the most important things, okay, that you know, I think when you take a look at what's driving the market, okay, because of the lower interest rates, the future cash flow, because that's what you're buying when you're buying a company, right? The future's earnings yield looks more attractive. And with Abenomics in Japan and the amount that they're buying at this point, the U.S. just ends up looking like one of the strongest economies in the world right now because we're coming out of our quantitative easing. Others are, you know, starting or, you know, at the latter stages of theirs. And one of the things that ends up doing is that makes the U.S. dollar stronger. Right, Tom, you and I have talked about this, about how strong the dollar is compared to your euro,
I'm looking at the euro chart right now. We're about 50 pips off a 3-year low and maybe 100 pips or 200 pips off of a 5-year low.
Right, if I take a look at 6E in the futures.
Yep. So clearly the U.S. dollar is strengthening.
Okay. What you're looking at is a monthly chart going back more than a decade. So this right here is the rest of the world still in quantitative ease mode, and us coming out of it.
Yep.
Okay.
John Dory had an observation. Don't you think the market is massively overreacting to the prospect of a gradual series of rate hikes? there's been so much lead time that it seems the prospect should be thoroughly priced in by now.
Definitely, John, without question. It's a, I think that the lead time, the sell-off, I think it was also, quite frankly, I think it was a lot of market manipulation, because if I go back and I take a look at the VVIX, and I take a look, by the way, look at these spikes, okay, on the monthly side. I wanted to end up showing you that, okay. Look at the spike that we ended up having in October, and look at the spike that we have here in December. Now, when I end up going and I end up taking that, let me just bring it down to weeks, so you can see what the week looks like, okay? And here's the spike up and the spike right back down, okay? I think that when you step back and you look at things in a little bit clearer light, and you're not focused on the leaves, but you can step back and see the forest, you can end up seeing, what do you call these except for overreactions? Or are they market manipulations to end up trying to drive, okay, people out of certain markets? Okay, a lot of people got burnt who always want to end up shorting the volatility products because they end up moving down over time because of their contango drag. I'm sure a lot of them who were maybe a little bit over-leveraged got burnt. It was a very, very difficult thing. Like if I end up coming over here, and let's go down to the day chart. Okay, here's the spike. And if I end up showing you something like, let's say, let's overlay on top of this so you can actually see it. I think that would be the best way to end up doing it. Study, edit, study. Let's do a compare. Let me do two of them. First one, I'm going to end up taking a look at. I'll make the chart the VIX, and I'll make this one the VVIX. And the second one, I'll end up making the VXXO, right? That's the most liquid of the VIX-based products. Let me hit OK. Let me come over here and put the VIX. Okay. To me, that's quite telling, right? The VXX or any of those products didn't have nearly the jump that everything else did. Why? Because we didn't go into severe backwardation. Okay, if I end up taking this and let's take it a shorter time frame. Let's take a look at maybe just over the last 3 months, so that you don't end up having, right? There you can end up seeing it a lot clearer. Yes, the VXX moved up, okay, but it didn't move up as high as the VIX. So when you get that level of look at the level of separation you got here versus the level of separation you got here, where the VXX moved up pretty much in tandem. I'm sorry, the VVIX, I said that backwards, I apologize. Where the ETF never got into backwardation except for a short period of time, so it didn't quite have the spike. Also, selling vol going into December is something that's worked for about 15 years. This was the first time in over a decade that volatility moved up in December. So it was quite substantial. It was quite substantial. So,
it is. It's amazing. So I think there's no more questions. Do you have anything else to go over, Jim?
No, that was pretty much, what I wanted to end up talking about in market analysis this week. Next week, I'll take a look at a couple more research reports, and I'll try to share something, some interesting piece of research that I can end up finding with you guys. To me, I think it's pretty exciting that tomorrow, I have an old colleague of mine, John Locke, who's going to be coming on. And he's going. I'm sorry. Go ahead. Why don't you do the intro?
Yeah, John and I were setting something up for January, and we actually had a kind of miscommunication. I thought he was coming on in January, but it's Dave Thomas, and he wanted to come on tomorrow. So hopefully everybody got an email about that, and you will be getting another one tomorrow about half an hour before the meeting starts. So the meeting's at 4:30. But John wants to talk about the M3 going into expiration and dealing with large market moves. So it should be a very interesting meeting tomorrow.
Yeah, I really, really look forward to it because the way John's butterflies are set up below the market, he is set up to be able to end up capturing these large moves, especially as you get closer to expiration. It's one of the really, really nice strategies where the thing that I like about John's strategy the most, if you remember what we ended up talking about with Bill Visconto, Bill Visconto said that he ended up showing us how straight iron condors don't work nearly as well. Because remember, those were the trades where you'd make a little, make a little, make a little, and then when you lost, hopefully you could end up managing it. Well, what ended up happening is because of the way the skews have worked, it's taken away your edge. So what John's basic trade is that when he ends up having a pullback, he has a chance to make a lot. And what he's done is he's built a management style so that if the market is ripping, he's constantly adjusting it so that his losses aren't that great. And in many cases, he's built his management style so that he can actually make a little bit, okay, when the market moves against him. So very, very, very strong. Every strategies have their strengths and their weaknesses. I think John's done a really, really good job to take what's the weakness of most others and turn it into a neutral, okay, I think at worst, or, a slight positive when the market's grinding up. Only if the market ends up ripping down and volatility goes through the roof and you don't react quick enough, does John's strategies get in trouble. However, with the volatility that high, it gives you an opportunity to put on the next month for even much better pricing.
Right.
So that's what I really, really like about the way John ends up trading this. And I look forward to hear what he has to end up telling us tomorrow.
And one thing to note that when John's very popular, and when he comes on, the last time we had about 90 people in the room, and we can only hold 100. So if you want to watch it live, and I think it'd be fun to do, make sure you get it early. I'm going to have the room open at least a half an hour before, so at 4 p.m. Eastern. So if you'd like, just go ahead and join and just leave your computer on, and you'll make sure you save a seat.
Oh, by the way, you're not the only one who got the warning. Okay, Tom also warned me earlier today that I better get on early.
Because there's a chance. You don't want to get locked out, Jim.
No, I don't. I really don't. I'll be signing on early, I promise. Anyway, thank you very much.
Thanks, everyone.